HunterMaclean, the Director of Business Development. And on behalf of HunterMaclean, Hancock, Askew, Private Bank, welcome to our presentation, a focus on giving and taxes, making impacts, and anticipating change. We are going to give Zoom a minute to admit everyone into the session before I turn things over to our presenters, but I will go ahead with a few quick announcements. This presentation is being recorded, and a link will be emailed post-event. We do invite your questions and ask that you use the chat feature to submit them. As we'll hold the Q&A session to the end of the three presentations, please note who the question is for so that I can direct them to the appropriate presenter. We'll start here with a quick disclaimer. The information contained within this webinar is provided for informational purposes only and not intended or legal advice from a professional accountant, attorney, or financial planner. Please contact an advisor for assistance and to discuss your specific situation. And with that, I will introduce our first speaker. Susan Clifford is a principal at Hancock, Askew & Company with over 35 years of experience in both public and private accounting. She serves individuals, fiduciaries, partnerships, family-owned businesses, and nonprofit organizations in the areas of tax planning and compliance. Welcome, Susan. Your first slide is up and ready.
Thank you very much, Andrea. And to all of you who have joined us, my fellow panelists and I say thank you for spending this time with us. We hope you find it informative. Benjamin Franklin famously said, "In this world, nothing can be said to be certain except death and taxes." The old proverb says, the more things change, the more they stay the same. Tax laws come and go, but taxes stay. And the time-tested approach of deferring income and accelerating deductions to minimize taxes still works for many taxpayers. With the doubling of the standard deduction, many taxpayers should consider bunching, moving their expenses into as many itemized deductible expenses into 1 year so that they can take the itemized deduction and then taking the new higher standard deduction in the following year. With the $10,000 tax limitation, most taxpayers are unable to bunch their taxes because they already reached the $10,000 limit. But for taxpayers who live in a state that does not have a state income tax, such as Florida, they might actually be able to bunch their real estate and personal property taxes. You can bunch your mortgage interest by making 13 payments in the year you're bunching and making 11 payments in the year you're taking the standard deduction. And you can bunch your charitable contributions by making your charitable contributions in the bunch year and then in December prepaying your charitable contributions for the following year. One way to do this is a designated fund, which Tom will be discussing later in the presentation. Next slide, please. In 2017, the Congress passed the Tax Cuts and Jobs Act, which is effective for tax years 2018 to 2025. This is the same, these are the rules that you filed your taxes in for 2018 and 2019, so I'm sure you're all very familiar with them. Some of the key features are the reduced tax rates, the doubling of the standard deduction, and the child tax credit for children under 17, which doubled to $2,000, but for other older children and other dependents, it decreased to only $500. And the other significant event was the doubling of the estate and gift tax exemption, which is indexed for inflation, and for 2020 is $11,580,000. Next slide, please. As you can see from this table, the marriage penalty has been eliminated for couples earning up to $414,700. Previously, the marriage penalty ended in around the $70,000 level. Next slide, please. While we remained under the TCJA until 2026, that hasn't stopped Congress from passing additional tax laws. The Taxpayer Certainty and Disaster Relief Act was designed to bring back some of the most popular and widely used tax breaks that had been omitted from the larger original Tax Act. Among those, these are four of those are the most popular, and of these, the mortgage insurance premiums being treated as qualified residence interest for itemized deduction purposes is probably one of the most widely used. If you happen to have been eligible for one or more of these deductions in 2018, you should consider filing an amended tax return. Next slide, please. So after the next Tax Act to be passed was the Secure Act, setting every community up for retirement enhancement, which is designed to encourage and increase savings for retirement. This act repealed the maximum age for contributing to a traditional IRA. Now anyone with earned income is able to make a contribution, and it increased the initial required minimum distribution age from 70.5 to 72. This act additionally allows penalty IRA withdrawals of up to $5,000 for within a year of the birth or adoption of a child, and it eliminates the non-spousal stretch RMD provision that have permitted beneficiaries of inherited retirement accounts to spread the distributions over their life expectancies. And I was going to re-ask for the results of the poll, but Andrea, I'm not sure we actually sent out a poll.
We did not. I'll go ahead and launch it now.
Well, I think people will know the answer, but under this new law, non-spousal beneficiaries have only 10 years to withdraw the entire balance from their IRA. Since this change, those taxpayers who are charitably inclined should consider leaving a percentage of their IRA rather than a cash bequest to the charity or charities of their choice. Say, for example, that you have $1 million IRA that you want to leave to your child, and you would like to leave a $100,000 request to one or more charities. If your child withdraws the IRA equally over the 10 years, in the first year, he or she will take $100,000 and will be subject to income tax, which could be as high as 37% federal plus state tax. So will likely end up with somewhat less than 60% of the $100,000. Meanwhile, the charity will get the $100,000 bequest and end up with $100,000. However, if the charity were to receive 10% of the IRA, in year one, the charity would receive $100,000 from the IRA, and being tax exempt, would receive $100,000. Your child would receive the $100,000 cash bequest and end up with $100,000. And at the end of this, your child would still have $900,000 in the IRA to take over the 10-year period. Next slide, please. And if we have the results of the poll, which I'm assuming everybody will get correctly, we can certainly see those. Yes, everybody is able to read, and yes, 10 years is what you're now required. If you're a non-spousal beneficiary, you only have 10 years to withdraw. And this actually should make people, whether or not you're charitably inclined, you may decide that it's better to perhaps give some portion of your IRA directly to grandchildren if your children are going to be in their highest earning years during the 10-year period, because they'll lose quite a bit to state income taxes. So it is actually worth a conversation about what is the best plan. So the Secure Act, in addition to what we've just talked about, have several provisions that apply to employers, and what applies to many high-income taxpayers is the reinstatement of the kiddie tax based on the parent's income instead of the trust return rates. Basically, this is effective for 2020, but parents or taxpayers have the option of using the parents' rates for 2018 and 2019. This came out in plenty of time for the 2019 tax year, But if in 2018 you were to have filed your child's tax return based on the trust rates and the taxes would have been significantly lower using the parents' rates, you may want to consider amending your child's tax return. Next slide, please. So now we arrive at 2020 and the COVID-19 pandemic. Congress passed the CARES Act, which we've of course all heard about, and the most widely discussed and most familiar is the $1,200 refundable tax credit against your 2020 taxes, $2,400 for joint filers, and $500 per qualifying child. Of course, this phases out for higher income taxpayers, so you can see the phase out. So higher income taxpayers obviously will not receive this benefit. Another well-known provision is the waiving of the required minimum distribution rules for certain defined contribution plans and IRAs for 2020, so RMDs are not required. There are two perhaps less widely known provisions that relate to charitable contributions. One is if you take the standard deduction in 2020, you're still eligible to take up to $300 charitable contribution against your adjusted gross income. And also, as we all know for many, many years, you're limited with your charitable contributions. It used to be 50% of your adjusted gross income. The TCJA changed that to 60%, but in 2020, if you're in a financial position to do so, you are able to deduct charitable contributions of up to 100% of your adjusted gross income. And another provision of the act that is widely applicable is that student loan payments on federal student loans are deferred until December 31st, 2020 without penalty or interest. Next slide, please. The CARES Act also has some rules for your retirement accounts. Under the new law, you can waive the early withdrawal penalty of 10% is waived for distributions of up to $100,000 from tax qualified retirement plan accounts for coronavirus related purposes during 2020. These taxable amounts, the income tax, of course, is still applicable, but it can be included ratably over 3 years, thus reducing the amount of tax you pay each year and obviously deferring the tax on the future year's payments. And taxpayers who are in a position to do so may recontribute the funds to an eligible retirement plan within 3 years and without regard to that year's cap on contributions, meaning you can recontribute the funds you took out, and while you're meanwhile contributing up to the maximum amount you're able to for either an IRA or a retirement plan, whichever is applicable. And there's a list here that you can read, obviously, but coronavirus related distributions you're eligible for this if you were diagnosed with COVID-19, you had a spouse or dependent who's diagnosed with COVID-19, or that you experienced adverse financial consequences as a result of COVID-19, the quarantine, being furloughed, laid off, etc. And also the plan, for those plans that allow loans, and not all retirement plans do, but if your retirement plans permits you to take a loan, there's some increased flexibility for if you're taking a loan for coronavirus related relief. Next slide, please. So we've talked about where we are with taxes, and now we turn to what might happen. Obviously, we don't know who's going to win the presidential election, and we don't know clearly if the president wins, whether or not he will be able to have what control that they'll have over Congress. So that whether the fact that these are proposals that they're talking about certainly doesn't mean that they will be enacted into law, even if the individual wins the presidency. But Biden is proposing a return to the top rate of 39.6% for incomes over $400,000. He would also like to apply the FICA 12.4% tax to earnings over $400,000. Right now, in 2020, income over $137,700 is of course subject to the Medicare tax, but is not subject to FICA. Under his proposal, there'd be a donut where there's a period where you're not subject to it, but these very higher income taxpayers would be, again, subject to it. He would like to cap the benefit of itemized deductions at 20%. If you are fortunate enough to earn over $1 million, he would tax your long-term capital gains and qualified dividends at ordinary rates, which if you're there would be under his proposal 39.6%. He would increase the child tax credit to $8,000, $16,000 for 2 or more children. He would provide a special tax exclusion for student loan forgiveness. He would eliminate the step up in basis on inherited assets, and he would allow the estate tax exemption to revert to the $5 million inflation adjusted, presumably after 2025. Next slide, please. So President Trump's proposals, no surprise, he'd keep the top tax rate at 37%. He would like to implement a 10% tax rate cut for middle income taxpayers, which would effectively lower the 22% rate to 15%. He would make the changes to itemized deductions permanent. He would extend the $2,000 child tax credit past 2025, but require Social Security numbers to be eligible. He would eliminate, quite the opposite of Biden, he would eliminate the 20% tax on long-term capital gains for high-income taxpayers. He would index long-term capital gains to inflation. He would like to create a capital gains tax holiday for a period of time to be determined. He would eliminate the Social Security tax for employees. Not sure how he's going to fund Social Security, but he would provide a tax credit for contributions to state-authorized organizations sponsoring scholarships, such as we have in the state of Georgia. And he would extend the current inflation index state exemption, a state tax exemption. And this was a relatively brief and rather rapid overview of where we are with federal taxes, with a quick look at what might be on the horizon. For most of us, taxes are a significant financial outlay, and conversations about charitable giving always have taxes hovering somewhere in the background. Now that we have an overview, my fellow panelists will discuss charitable giving in more detail. Thank you very much.
Thank you, Susan. It is interesting that most studies show that taxes are not a top priority for donors, but it is often a point of discussion. And with that, let's welcome Tom, who is joining us by phone today. Tom, are you there?
Sure am, Andrea.
Very good.
Good afternoon, everybody.
Thank you. Tom Lawson is a managing director for Bank of America's Philanthropic Solutions Group. He nationally represents Bank of America's donor-advised fund practice for new business opportunities and interactions with existing clients and client advisors. Tom has over 38 years of professional experience working with individuals, families, and philanthropic organizations. And as we turn our ears to Tom, I'm going to launch the next polling question. I messed up on Susan, sorry about that, but I'm going to go ahead and launch this for Tom since he can't see it. Okay, although donor-advised funds, unlike private foundations, do not have a required minimum charitable distribution, what is the average annual distribution a donor-advised fund makes? And with that, while you all answer, I will turn it over to Tom.
Thanks, Andrea. And to Susan and Alan, I'm honored to be on the same docket with y'all this afternoon. And I would express my best wishes to those that are participating today, that you and your loved ones remain safe and well during this time. Andrea raises an interesting point and a question in that what importance does tax planning have to do with charitable giving, and how does all that deal with donor advised funds? So what I'd like to do in our time together is to, emphasize that donor advised funds are extraordinarily popular in this country, to talk a little bit about what is a donor advised fund, and then why are people using them, and how does that all tie back to charitable giving and taxes. So to begin with, I consider the donor advised fund to be the charitable Swiss Army knife. And as we go through this time together, I hope that you'll see the many uses and the reasons why I describe it as such. To begin with, donor advised funds are extraordinarily popular in our country. There's a study that's done every year by a national provider called National Philanthropic Trust that showed in the last fiscal year, they accounted for 2018, over $37 billion was given to donor advised funds in this country. And as an industry, if you accumulated all the assets in donor advised funds together, it would top over $150 billion. I can remember my first interaction with a donor advised fund 23 years ago when I worked for a public university in North Carolina. And we literally didn't know what to do with the check that came from this place called the Fidelity Charitable Gift Fund. So they are extraordinarily popular. They are no longer the little brother of private foundations in terms of size, even though you can use a donor advised fund for an initial contribution as low as $5,000. So what is it? A donor advised fund is just a phrase that's used for a public charity that offers an administrative service called donor advised funds. So when you make a gift to an entity that has a donor advised fund administrative offering, it's no different than making a gift to your alma mater or where you worship, or even the local food bank in terms of tax deductibility. So a donor advised fund is a public charity. It's a service that's provided. And because you're making a gift to a public charity, there are certain benefits that accrue to you as the donor that have made these extraordinarily popular. Number one, you can make the gift of the asset that works best for you when you want to give it. And let me explain. If you have a particular stock position and today on September 29th, you feel like that stock has run out of gas and you don't like what it looks like over the next few years, or it's a larger percentage of your portfolio, you can make the gift today to a donor advised fund of that stock. When you transfer the ownership of the asset, the donor advised fund receives it, sells it, pours the net proceeds in an account in your name, and gives you an acknowledgement back for having made that gift. That's a key planning point on why donor advised funds are popular. Before I began using a donor advised fund about 20 years ago, I literally gave my accountant, and I'm sure Susan will chuckle with this, the proverbial shoebox with 20 or 35 receipts in it in any given year for the accountant to factor in how much I'd given away. Now I simply give my accountant the acknowledgement for the gift I made to the donor advised fund. So simplicity in terms of kind of management of charitable giving, the ability to make a gift when it works best for you. And also with this comes privacy. It's interesting, donor advised funds are actually private. Private foundations are actually public. And what I mean by that is the private foundations, as anyone who works for a tax-exempt organization or has raised money as a volunteer in their life knows, the private foundation tax returns are on a public website called GuideStar, where you can see what's in the foundation, what they gave to, who's on the board, etc. If you were to go to the tax return of a public charity that offered a donor advised fund solution, you would not be able to identify the value of the specific individual donor advised funds or what they've given to. In like fashion, you have the ability to make grants anonymously. We actually have a client that calls his donor advised fund the Robin Hood Fund, and he's made grants for years and no one has any idea who he is in his community. Another reason why donor advised funds have grown in popularity is because they are much more ready and prepared to handle non-cash asset gifts. So back to the question around the topic of taxes, all public charities or people that work for public charities or served on the board understand how difficult it is to take a gift of a non-cash asset. And by my definition, that's anything that you can't monetize at the bank today or in trade plus 2 days. So companies held in S Corp, C Corp, or LLC form, investments in real estate, commercial or residential, restricted stock, hedge fund, private equity, even things as esoteric as cryptocurrency, capital gain property, which is the best asset to consider giving away during a lifetime from a tax advantage standpoint. Now the donor advised funds are better prepared to take those assets in and deal with them and monetize them over a period of time in a cost-effective and efficient way. Think about that from the client donor's perspective. If I'm selling my business for $10 million and I am charitably inclined and I'd like to make a gift of $2 million of S Corp, of the S Corp stock in the business ahead of the sale, I probably don't know where I want the net proceeds to go to, because $2 million is probably more than I've ever contemplated giving away in my life. So by making the gift to the donor advised fund, I can take the charitable deduction, hold the assets, and then have time to decide. So these donor advised funds have increased in popularity because they hold the tax advantage of a public charity. They give you the opportunity to make a gift to one entity and then decide how you want to distribute over time. And Andrea, since I can't see the poll, would you give me the results of the poll right now?
I sure will. 42% went with the 10%, 15% of the people went with 15%, 27% of our folks guessed 20%, and 15% guessed 25%. So the overall winner were people who guessed 10%.
Fantastic. That's I appreciate your participation. It's interesting, in that study of the donor advised fund industry, every year they take a look at the annual distribution, average distribution, because there's been a lot written and said over time about donor advised funds having to have a required annual distribution. And as you know, today under IRS regs, there is no required annual minimum distribution, but the average is answer number 3, 20%. And there's been a lot that's been written during COVID about the importance of donor advised fund donors having, if you will, charitable dollars on account, that in the early days of COVID in March and April, as the market was tanking, I'm sure we all have forgotten those painful memories, 30 or 40%, people were able, because they had charitable dollars they'd already given away, to support causes and needs that immediately popped up. Almost every community seemed to have its own COVID fund. So that's another reason why. So I can make a gift to a donor advised fund in December of this year, after my accountant, Susan, calls me up and says, Tom, you've had a great year. You need to give away another $50,000. I can make the gift to the donor advised fund, take the charitable tax deduction in 2020, and then move the balance forward for future grant making. I'd end with this, and this would just be my encouragement, regardless of kind of which category or categories you fit into, whether you're an advisor to clients, whether you're a donor to charities, whether you work for a public charity, or if you actually serve on a board. You really need to understand what a donor advice fund is and why people use them. My encouragement would be to make sure you understand how they work, but also to remember it's a fantastic giving tool as an individual, but also if you work for a public charity, anybody that's making a grant to you has dollars on account. So I'll end where we began. Our own study of high net worth philanthropy, we've done 6 of them. The 7th one will actually be released next year, shows that the charitable tax deduction ranks about 7th on the top 10 list of why people give. People do make decisions based upon good charitable tax giving, and we found donor advised funds to be great solutions. Andrea, I'll turn it back to you with that.
Great, thank you so much, Tom. And now we shift to Alan. Alan Brown is a partner at HunterMaclean, specializing in the practice areas of estates and trust and taxation. He has earned a strong national reputation for developing innovative estate planning and business strategies for family-owned companies and high net worth individuals throughout the country. And we are excited to have him with us at HunterMaclean. Welcome, Alan. The floor is yours.
Thank you, Andrea. Thank you, Susan and Tom. And thanks to everyone who can join us today. It would have been fun to do this in person, but obviously this is a very unique year and we're going to enjoy each other by video. I'm going to focus on asset protection. Could we go to the first slide, please? And estate tax protection. The most important thing I want to leave with you is that when you do good planning to protect your assets from creditors, you don't then do something else to protect yourself from estate taxes. Asset protection takes care of estate taxes, not the other way around. The most powerful asset protection in American law is a trust that someone creates for you. My joke is, my hope is someday someone will create an asset protection trust for me, but it hasn't happened yet. So we're also going to talk about a particular kind of trust, and I'm going to use the label dynasty trust. That's something that's well known to lawyers, accountants, financial planners, trust officers. So as soon as you use the label dynasty trust, anyone hearing that automatically knows a couple of things. It's an irrevocable, not changeable trust. It's exempt from all what I call the federal transfer taxes, the gift tax, estate tax, generation skipping, transfer tax, and it will operate for the maximum period of time in the law of the state in which it's established. Some states still have a limitation, maybe 90 years. Other states, I'm licensed in Illinois, they have an unlimited period. I'm licensed in Georgia and do work in Florida. Georgia and Florida have a 360-year. So I need to know the state in which it was established to know how long it will be operating. But the most important thing that the Dynasty Trust label tells me is that this is a spendthrift trust, which is a word of art that says no creditor can touch the trust assets. So who are the people involved in a trust? Well, the trustees on one side having the responsibility to manage the assets, and we have the beneficiaries on the other side who have the rights to receive the assets. No creditor of a trustee can under any circumstances touch the assets of a dynasty trust. No creditors of a beneficiary under any circumstances can touch the assets of a dynasty trust. So it is the most perfect asset protection we have available. In addition, the estate tax is very simple. You pay estate taxes on what you own. You don't pay estate taxes on what you don't own. So by having assets in a trust, either you put them in the trust or someone put them in the trust for you, you don't own them. They're out of your estate for estate tax purposes. As Susan mentioned, we have a exceptionally high, highest in the history of the estate tax exemption, 11.5 per person, 23 million per couple. that automatically drops to 5 per person, 10 million per couple in 2020, after 2025. And political candidates, Biden is saying 5, but we've heard others say 3.5. So what I know with absolute certainty is what the exemption is today in 2020. I don't know what's going to happen in 2021 or 2022. So everyone should be focusing on asset protection now. And as I say, the estate tax protection will follow. Andrea, can we do the next slide and launch the poll, please? So if you are a person who makes a gift to another, obviously you no longer have control of that asset. Obviously, you no longer have access to that cash. So in a couple, what we do is we create a husband for wife trust and a wife for husband trust. So husband and wife controlled all the assets to start. Between the two of them, husband and wife continue to control all the assets after we set up the 2 asset protection trusts. You'll notice in my hypothetical couple, Jim and Emma, slightly different in the right-hand box, and that's because of a IRS and tax court rule called the reciprocal trust rule. If husband and wife, wife for husband, create identical trusts down to the comma, the IRS gets to ignore that trust. All of those assets are still in the estate for the estate tax purposes. So we make the trust different in some important ways. So for example, Jim has as the beneficiary of his trust only his wife, Emma. The trust continues for Emma's lifetime, and at the end of Emma's lifetime, it will divide into trusts for their children. Emma's trust has as the beneficiaries right now both Jim and all of their children and all of their grandchildren. Obviously, completely different beneficiaries, and Emma's trust is going to last for the lifetimes of both Jim and Emma. It will not divide into trust for children until after the death of the second to die of Jim and Emma, a completely different term of trust. So during the lifetime of Jim and Emma, they continue to control the assets the same as they did before they set up the trust, and they continue to have access to all the cash the same as they did, but yet they've achieved complete asset protection and complete protection from any estate taxes. Andrea, can you tell me the results of the poll? So we have creditor protection is the priority for 30%, estate tax protection is the priority of 70%, and I apologize, it was a trick question because the Dynasty Trust gives you 100% creditor protection, asset protection, 100% gift and estate tax protection. One trust accomplishes both of those objectives. Next slide, please. An additional layer of asset protection is a company. A company, my favorite is a limited liability company taxed as a partnership. That's the simplest kind of business I know how to set up. Owned and controlled by the family. Gives you an additional layer of asset protection because if someone has a share of an LLC and a creditor takes it, the creditor cannot get through the LLC into the assets held by the LLC. So this is a second layer of asset protection. More importantly, it gives several additional benefits. First, if I'm giving some assets to husband's dynasty trust, some assets to wife's dynasty trust, I may have split assets. I may have split a piece of commercial real estate. I may have split stock in a family company. It's more difficult to manage an asset that's split in half than it is to manage it in one place. The second reason is that for gift tax purposes, if I give $100 worth of stock to a dynasty trust, it's obviously worth $100. If, on the other hand, I have given a whole series of assets to a family limited liability company, and then what I actually give to my dynasty trust is half of that family limited liability company, two things happen. First, because there's no public market, and because I only gave 50%, I did not give a controlling interest, the gift tax rules are clear that that's entitled to a valuation discount. That requires a professional appraiser, but I've seen appraisals anywhere from a 25% discount to a 50% discount. So the effect of that is for a given size of gift that you report on a gift tax return, you now have more assets. So instead of my $100 credit, it's now a $75 gift or a $50 gift. One of the favorite things I do is defend audits of gift tax returns and estate tax returns from IRS audits. And what we have found is simple is better. So imagine that I want to give 32 different assets to my dynasty trust. I'm going to give half, my wife is going to get half. If we do it that way, each of our gift tax returns will list all 32 assets with their separate description, with their separate valuation. If instead my wife and I contribute those 32 assets to a family limited partnership, and we each own 50% of it, and we each give 50% to our respective dynasty trust, then you can go to irs.gov, you can look up IRS Form 709, which is the gift tax return. And if you envision it with me, it is the simplest return impossible because it's going to have one schedule with one item, and it will say 50% of Allen's Family LLC, comma, valuation or appraisal attached, period. That's it. There's nothing to look at. There's nothing to scroll through. To the extent that we have, IRS gift tax audits have been fairly rare because fewer and fewer auditors are working because of budget cuts. But to the extent I get one, I would love to defend a gift tax return that was as simple as one item. My final reason for liking the Family LLC is training children. I think that it's unfair to ask children to inherit money without giving them the training to do a good job of managing that money and handling the responsibility of owning that money after the death of mom and dad. So in my Family LLC, I have a couple of great opportunities. The first is I may have some, I'm going to call them loose assets. Grandparents made some gifts to grandchildren, and those are in Uniform Transfers to Minors Act. The stock market has done well, and surprisingly, those are several $100,000 per child. Do you really want a 21-year-old to have a check for $180,000 in cash at age 21? Most families would say, no, not great. Or you have children who have successfully started their own careers, and they have some money that they would like to invest, and they would like to invest it with mom and dad. Mom and dad are the best investors, so let's package that all together. And finally, let's have the children who are adults at an appropriate age become officers of the Family LLC, and let's have mom and dad give them complete specific tasks, have them complete the task, have them get paid for those tasks so that they learn how to operate a business successfully. Because after the death of mom and dad, in the typical structure, each child will receive a separate trust. Each child's trust will own a percentage of the Family LLC, and the children together will now be responsible for running that business. And to ask them to run the business with no training, that's a recipe for disaster. We don't want to accomplish that. Next slide, please. So we're going to have two groups of clients. The first group of clients, once they've assembled their Family LLC, the total value after gift tax valuation discounts is less than their exemptions. Terrific. Then in one step, we're going to finish their planning. We're going to have them make gifts. Husband makes 50% of the LLC gift to his dynasty trust. Wife makes a gift of her 50% to her dynasty trust. So far, the only two tools we've needed to handle up to 23 million, imagine some discounts. So probably we stuffed anywhere from 25 to $30 million into the LLC, complete asset protection, complete estate tax protection. Step two, or the two-step, is a relatively small group, and that group has been successful enough that they have way more than $30 million that they want to deal with. Obviously, we're not going to bump into very many of those people, but we need to tell them we've got you covered too. The two steps are, first, we are going to make a gift of LLC units, but we're going to make a gift of a percentage of the units equal to their exemption. And the second is we are going to sell the rest of their units. A very complicated subject that I'm going to do in 2 sentences. My dynasty trusts are grantor trusts. That means they're disregarded for income tax purposes. That means you can sell appreciated assets and not recognize the gain. You're going to pay interest on your note, trust to mom and dad, but you're not going to report the interest for income tax purposes. So this is just a gift tax rule. Right now, the minimum rate in September 2020, what's called the applicable federal rate, AFR, announced monthly by the federal government, is 1.00%. That means that your trust can borrow from you for 30 years, interest only, with a balloon payment at only 1%. If your trustee, you or your kids or your financial advisor, can't beat 1% in investments over 30 years, your family needs a new financial advisor. So if you have an amount that is equal to your exemption or less, one step, we're just going to make a gift. If you have an amount that's greater than that, no problem. I will let you borrow on a note 10 times the value of your assets. So if I did roughly a $20 million gift, you can lend up to $200 million. So until you bump into someone with assets of greater than $220 million, you don't need anything else but the 3 tools we've discussed. A dynasty trust, asset protection, estate tax protection, a family LLC for the discounts and for including and training children, and the promissory note only for the very largest estates. Can we go to the next slide, please? So let's go through these steps. First, we create our dynasty trust. That gives us perfect and complete asset protection and estate tax protection. Second, mom and dad, Jim and Emma, take whatever list of assets that they want to be in the family LLC. And because this is a for-profit business, we want as many diversified assets as possible. My favorite is it's got a little bit of everything. It's got some cash, it's got some bonds, it's got some stock, maybe some commercial real estate, maybe some residential real estate, some interest in any family businesses. Life insurance. Life insurance is a completely appropriate investment for a family LLC. To the extent the family has or wants life insurance, here's the place to pay for it. Here's the place to own it. Next slide, please. So now I'm going to transfer. Jim is going to transfer his half of the family LLC. Emma is going to transfer her half of the family LLC. If the size of the LLC is less than their exemptions, then perfect. We will complete the transaction with just a gift. If it's greater than that, and as we've discussed, that's a very few number of people, but we've got them covered too. We'll do a gift for the amount of their exemption, and then we'll do a sale for the rest. And that note for the sale this month can have an interest rate as low as 1.00%, lowest it's been in the history of the AFR. And next slide, please. And here's the point, because I don't think in terms of 10 years, I think of 100 years, and I think of how is this family going to be successful over 100 years? That's our current generation plus children plus grandchildren, maybe great-grandchildren, and I think it all comes down to training. And so here's my opportunity where If I have children with assets that need asset protection, I'm going to have the children directly invest and become owners of the family LLC. If I've got some of that grandparent gift money still in a Uniform Transfers to Minors Act, I'm going to scoop it up and I'm going to put it in the family LLC. So when those children reach age 21, they don't get a check for $180,000. They get a piece of paper that says, congratulations, you own 0.32% of the family LLC, and this piece of paper entitles you to come to the family meetings. And the child says, where do I cash it in? And the answer is you don't, not until mom and dad say you can. So we got asset protection, but we also got an opportunity for training. And if you look left, I've got the children are going to become officers of the LLC, and that gives them an opportunity to do real work, to get paid for that real work, to learn how to manage the business, and to have an opportunity to learn everything they need to know from mom and dad, because mom and dad created this wealth. So who better to teach them about this wealth? And at the same time, this is an environment in which obviously it's not just about money, it's about what's the mission of this family? What's the history of this family? What are the guidelines and the guideposts of this family? And this is a place to do that. So this is a for-profit business. It needs to have meetings, regular meetings. It needs to have annual, semi-annual, quarterly meetings. And maybe they're in person, maybe they're video or audio. But the point is the kids become very active participants. So when it's their turn to manage, it's their, they've had the training. They're ready to do what you wanted them to do. And then of course, my goal is we continue this for generations. The children have children. That's Jim and Emra's grandchildren. They need to have the same training. And then generation 3 passes on the training to generation 4. And I can't think much longer than that, much past that, but we would love, I won't be here, but someone will be here 100 years from now. And I would love for them to look back and say the generation of trust lawyers who set up these asset protection trusts in the 2020s, boy, did they do a terrific thing for this family, because look at what's still available. Here we are at the 4th generation. So thank you. I know that's a lot. I believe the phone number and email are available on this slide and will be available on our website. I would welcome any questions. Happy. It is my goal to educate everyone, because who wants to lose their assets to creditors, who wants to lose their assets to estate tax? Thank you, Andrea. Thank you, Susan. Thank you, Tom.
Great. Thank you, Alan. Let's see. I don't the chat box, which is quite all right. People can tend to be shy on these things. So what we will do is on behalf of our presenters, Susan, Tom, and Alan, I thank you all for joining us today, as well as on behalf of our firms, HunterMaclean, Hancock, Askew and Company, and Bank of America Private Bank. Thank you all for joining us. As a reminder, we will be sending out a video of this webinar later this afternoon. That email will also have all of our presenters' contact information. So if you do have additional follow-up questions, or when you review some of the information, something pops into your mind, we all welcome you to reach out to us, and we will address you individually. So thank you all again for joining us today. Have a great afternoon.
Thank you.